If you've ever looked at a business listing online and felt like you were reading some secret foreign language or some kind of alphabet soup with all the acronyms, you're not alone. Today, I'm going to break down 8 of the most common terms you'll run into when buying a business in plain English so that you can sound like a pro before you even make an offer. These are the words that brokers, lenders, and sellers use every single day. So to them, they don't stop to think that somebody new might not understand them. And understanding them isn't just about the jargon. It's about making smarter deals, avoiding bad deals, and knowing exactly what you're signing up for. Welcome to Business Buying for Financial Independence. I'm Tim Delaney, and I help young professionals buy small businesses so they can escape the 9-to-5 and take control of their time, income, and future. If that sounds like you, hit the subscribe button and let's get into it. First up on this list is SDE, or Seller Discretionary Earnings. You may have heard me mention this in previous episodes. It's something that comes up a lot when you're looking at buying a small business. Essentially, what this is all of the earnings of the business for a full-time owner of a business. So typically used when the owner is working full-time in the business. It includes all of the profit that the business makes. It includes the salary of the owner, and it includes any add backs or things on the expense sheet of the business that the owner is taking for themselves, or that are kind of perks of the business that the owner is enjoying that are not 100% necessary to run the business on a daily basis. Some people will consider the full salary of the owner as part of the SDE. Other people will only consider the portion of the salary above and beyond what the owner or what the person in that role should be getting paid is. So, for example, if I'm running my wine and liquor store day in and day out, and I am the general manager of that store, I would deduct what an average salary of a general manager of a liquor store would be from the SDE, because that salary is still required to run the business. So I would only count anything above and beyond that average number as part of the SDE. Other people just say it's the whole salary, which is what the SDE is, because the buyer is going to become the general manager, and so therefore all of that earnings is theirs. The reason that SDE matters, and it's a very important term when you're buying a small business, is that usually the value of the business is based off of some multiple of the SDE. It could be 1x, 2x, 3x, or more of that SDE. And that's how you determine the value of the business. Once you get into a little bit larger businesses, we have another term called EBITDA, 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 which is earnings before interest, taxes, depreciation, and amortization. A general rule of thumb is that if the seller, if the owner of the business is not active in the business day to day, if they have true management running the business on a day-to-day basis, then we shift into using EBITDA instead of SDE. It's a rule of thumb. It's not a hard and fast rule. It depends on the broker that is doing the deal. The difference between the EBITDA and SDE is that the EBITDA is generally the true profits of the business. It doesn't involve the owner's salary at all. It's just the operating profit of the business. And then adding back in any interest that was deducted, any taxes that were deducted, any depreciation or amortization that are on the expense sheet of the current business, because the new owners are not expected to pay those items. So when you're buying the business, you're going to start fresh with none of that stuff on your expense sheet until you take out your loans or buy heavy equipment or goodwill or other stuff that needs to be depreciated and amortized. EBITDA for larger businesses, SDE for smaller businesses. Our next term is LOI, or letter of intent. You've definitely heard me mention this in other videos as well. Essentially what this is a informal, formal agreement between a buyer and a seller. So before we get into a fully robust contract of sale between the buyer and the seller, we generally start with an LOI, a letter of intent, which just lays out the terms to which the buyer and seller have agreed. So it typically has the price, the financing terms, seller financing, if any, what is included, what is not included in the purchase, whether it's going to be an asset or a stock sale, when this is going to happen, how long the buyer has to do due diligence, other key points that must sustain in order for this deal to go through. You want to try to get as much stuff in this as you can so that it's easier when you move on to a contract, but you don't want to make it overly complicated that you need lawyers to spend a ton of time on it. The reason that you do an LOI instead of going straight to a contract is that you don't need the lawyers at this point to spend hours and hours and cost you thousands of dollars when you haven't even done the due diligence yet. But it also puts some guidelines in place like confidentiality and exclusivity. So during this period of an accepted LOI, it's generally accepted that the seller is not going to be entertaining other offers or other buyers. You can kind of consider this like being engaged. So you haven't done a formal wedding yet. You haven't entered into marriage. However, you're kind of frowned upon from going out and dating other people. So this is like an engagement phase, LOI, letter of intent. Next up, we have APA, or Asset Purchase Agreement. So this is where the actual contract comes into play. This is for an asset sale. So you're purchasing the assets, which is why it's an asset purchase agreement, which we get into the nitty gritty of the whole deal. So after due diligence, everything looks good. Buyer or seller want to move forward with the terms that were laid out in the LOI or maybe slightly adjusted based on due diligence. This is where the lawyers start coming in and drafting an asset purchase agreement that you can then go take to the bank to secure financing. This is going to have all the details, all of the nitty gritty of what's included, what's not included, customer lists, goodwill, equipment, anything like that is vital to making sure that you're protected as a buyer and making sure the seller gets what they deserve. Next term is escrow. This is a term you may have heard of if you've bought a house before. Mortgage companies usually hold escrow. In a business purchase, sometimes there is money held in escrow for a period of time to make sure certain things pan out as they were expected in the contract. For example, you might say, all right, we, as a buyer, I would like to see $25,000 in escrow for 3 months to make sure that that order that you said is coming through in the next 60 days actually comes through. It was promised that this buyer is definitely going to make this big purchase order. We want to see some money in escrow to make sure that that happens. Or there could be situations with key personnel that the seller kind of promises that are going to stick around after the sale. Maybe the buyer says, can we put $50,000 in escrow for 6 months to make sure that this key manager stays on the job for that period of time? It could be any kind of different thing. The seller's not always going to agree to having any money in escrow, and their lawyers are usually going to fight against it. But there are situations and scenarios where it makes sense. SBA, or SBA Loans. SBA is the Small Business Administration. It is a federal organization that facilitates small business all around the United States. They are most famously known for their loan programs, particularly the 7A loan, which is what is used to purchase small businesses. One important thing to note is that those 7A loans are not given to a buyer directly from the SBA. They go through a bank. So you still go to a bank like normal, and there are banks in your area that are known for working more closely with the SBA, and then the SBA guarantees a portion of that loan for the bank. So banks tend to like working with the SBA because they have less risk. It is important to note that the SBA does care more about the cash flow of the business than the collateral that you bring to the table. And they're good for that purpose in that they help you vet the business as well. Next term is seller financing. So seller financing is when the seller becomes the bank for you. or they can fund the whole deal, or they can fund a small portion of the deal. Essentially, what the seller does is says, I'm going to sell you this business for $100,000. I will lend you $80,000 to buy this business. So you're writing a check for $20,000, and then every month for the next predetermined term, you're writing another check to the seller as the bank. This is very valuable to a lot of people when buying a business, especially if the banks or the SBA don't like that business or that industry for some reason. It's also pretty common for the seller to do 10, 20, 30% seller financing, even if you are also getting a bank loan. The SBA loves to see a seller that's also willing to do a portion seller financing in addition to the SBA loan. And like I said, these can range from anywhere from a couple percent up to 100%. We had Lindsay Zajac on episode 5 that talked about buying her business with a 100% loan from the sellers. Last term for today is working capital. So after you've purchased the business, you need working capital. This is the cash, the receivables, the inventory that is available to the business to keep operations going. Without working capital, the business will die. When you're purchasing the business, it is important to make sure that you have working capital to work with after you close on the deal. This is where going back to the LOI and the APA is very important to make sure it's specified whether or not you're buying the receivables. If you are buying a business that has 30, 60, 90-day terms with their customers and you don't buy the receivables, you are going to need cash to cover yourself for the next 30, 60, 90 days before your first customers start paying you. Or if you buy the receivables, you should be getting money right away. So working capital is all of the cash that you need to operate the business on an ongoing basis. And then just making sure that you've clearly defined in your purchase agreement what working capital you're getting with the purchase of the business. Those are 8 terms that are commonly used in a small business acquisition. Would love to hear what other terms you've seen or heard that you aren't quite sure about. We can dive in and explain those for you. Please hit us up in the comments. And if you got any value at all today, please take a second to hit the follow or subscribe button wherever you are listening or watching to this. Really appreciate it. Thanks for your time. See you again soon. Cheers. Thanks for listening to Business Buying for Financial Independence. If you're serious about owning your time and building long-term wealth, make sure to subscribe so you don't miss the next episode.